SJ Fibonacci here, and welcome back to 438 Forex channel. I feel like it's been a minute since I've shared any content. Kind of took a break from from trading and just to focus on life's happenings. 2024 was a packed year, but 2025 I brought with it new energy. I'm pumped and I'm ready to go. And for those who are, if for your first time viewer, just to let you know what this channel is all about, right? So I created this channel to document my journey to Forex profitability, right? Um, I currently trade or I trade, but I'm a Forex trader, but I'm not profitable. I'm not profitable. I don't mean I don't make consistent profits. I don't mean I don't make profits in it at all. I do make profits, but it's not consistent. And what I've been telling myself this year is that I need to be able to extract an income from the market. So every month they get that you get if you work, every month they get paid. That is what I want from the Forex. I want to get an income from it every month. I'm not trying to be rich from it. I just want to be able to extract an income, however big that is. Right. So this whole challenge is to document that journey. Forex has kind of been marketed very irresponsibly in the last couple of years, especially coming with the COVID. It's not this get rich scheme. It's not this get rich quick scheme that the gurus make it out to be. And again, if you've been a long-standing viewer or subscriber, then you'd see that I've made multiple pivots in this entire journey, right? I started with prop firm challenges with the intent of building up some consistency, but then I realized that prop firm challenges are for people who can actually trade. So prop firm challenges are for people who have capital issues, so they can trade, but they have capital issues too, and they do that to kind of increase their earnings. I'm not at that stage yet. At least I don't think I'm at that stage yet, right? So pivoted away from that. Then I started to trade a small account. So it was like I think it was 200 US. And I call that series small account big habits. Because what I've noticed, I'm really self-aware, right, as a trader. What I've noticed is that I just have bad habits. So it's not like I'm not technically good at trading. I'm technically sound. By technical I mean being able to read the charts, make decisions. But my problem is that I have bad habits. I get emotional sometimes and I over risk and not consistent. I don't even know exactly at the time I didn't know exactly what I was looking for. I wasn't trading specific things. And so in that pivot, I would have started to use this journaling app called TradeZilla, not affiliate with TradeZilla. TradeZilla, if you're watching that, we need to get an affiliate code. All right. But very powerful tool I was using to journal my stuff, and it kind of forced me to be more organized and more systematic. So that's those two words. It forced me to be more systematic in my trading, right? And I had to pretty much define what I was looking for, which I ended up showing you, which I call playbooks, which they call playbooks. And so that kind of helped me. So I was actually started off the series well with the small account big habits. Was making gains, consistent gains on there. But then I kind of got a little I pretty much rushed the process, right? So I started make a little be consistent returns. And I decided, all right, I'm gonna do a demo, I'm gonna do a challenge or whatever, and this didn't work out. No, it was always weighing on me that I needed to give myself time. It takes time. I think what is it? It's 42 days to build a habit. Probably gonna take more than that to break it, right? Or I have to be systematic about how I build these habits. So it did. I had the idea last year around doing a demo challenge. And the idea was to use an account that I want to be trading in real life, right? Even if it's a funded account. Um, but I started it, but I wasn't as consistent with it. I never got around to doing it. I just believe that this year I needed to actually execute that plan. So the initial thought was to trade a $200,000 demo account for 6 months, where I work on trying to build those good habits, right? $6 risk. Um, Set limit daily loss limits, you know, um, trading a handful of pairs, documenting each trade, linking them to the playbooks that I have, being able to define only waiting on my trades and my setups. and stuff like that. Not entering trades at the end of the trading day. Like those are the things I need to get that were holding me back. I need to get those things in place. So I decided that, you know what, I'm going to try and do a 200K demo account for a whole year. That's the plan. I don't know if I can make it to a year. Maybe if things are really good at 6 months, I might decide to. And also, the idea is that at the end of the year, I should be in a position, hopefully, at the end of the year, I had consistent returns each month where I'm in a position to get a 200K funded challenge account. All right. So the idea is to buy a challenge somewhere, trade it, pass it, and then start to make consistent income from that. So that's the promised land. That's the end goal, right? That's the end game. Now, I started last week. The broker I'm using is actually RoboForex. That's what I use to do my live account. So I just created a demo account on RoboForex, and I would have started to trade. Now, last week it wasn't a bad week. I'm gonna get to I can't even get to it now. But the dashboard is just the trading journal is just so good. I really really like it, right? So this would have been that summary of my stats from last week. I think I traded 5 days of the week last week. Again, remember it's a $200,000 account, so this would have been 12,700 in demo gains. And again, trading demo and trading real life in my head, because again, I think my trading journey is so serious that it feels the same way. You don't feel any different than if you're trading real money. All right. And if you're trading Forex, if you're trading fund account, it's not even real money. It can be simulated money anyways. All right. So, but to me, trading is trading. I love it so much that I want to be doing well at it because right, remember this is gonna be the precursor for me actually going live. Right. So I think it's serious. So in the real world, if I was actually trading a 200K account, I would have made $12,795 last week. That's probably almost, or maybe it's 2 million Jamaican dollars in 1 week. If it was in fact a live account, right? So that kind of put things into perspective. And if you look at this, it's actually the 6% gains, 6%, 6 point something percent gains on that 200K account, which is why you will hear someone like Burn would say that he's a known trader in the space. He'll say that most traders do not have a trading problem. What they have is a capital problem. Imagine if this was a $200 account. So that's been $12.70 and 80 cents. But the capital allows you to scale those gains. 6% of 200,000 is $12,000. 6% of $200 is $12.80. 6% of $2,000 would have been $127. Right? 6% of 2 million would have been $127,000. Right? Which is what I intend to do at some point. Right? I tend to have like multiple, because you can have multiple accounts with multiple prop firms, and the idea is to scale the capital. When I get consistent, to scale the capital up to that point, right? So 6% in 1 week, I think is good. Now, what I'm going to do, I want to kind of go through each of the trades, or at least go through some of the trades. Maybe I should go through the one. No, I probably should just go through how I use the journal in my system now. So I've made $2,000 last week at a 40% win ratio. So think about that. I lost 60% of the trades I took. All right, and some of them not some of them again because I'm still haven't gotten to the place where I'm consistently trading just my setups. Some of them may not be a proper execution of my setup, or there are different factors that would have led to them losing. To be honest, I would have gone through all the trades as well. So I'm gonna actually go through them. So I do a weekend review at the end of the week and see where I went wrong. There's a case where it wasn't my setup, or I entered too early, or I never wait for the rejection. I go through them. I think it was like 15 trades in total. Yeah, 15, 6 and 9. So I lost 9, won 6. This is a very important metric of mine, right? So it's what it's saying is that my average loss. So on average, I'm losing $1,000 per trade, but my average win is like $3,000. Once it is above 3, I'm fine. That is my goal. I want it to be 1 to 3. What it means is that because what I'm actually going for each trade, I'm risking like 1%. in each trade. So there's that. I'm risking only 1% of the account, which is $2,000 in each trade. And the goal is to go to at least 1 to 3. So $6,000 for each trade is a target. So I want this metric to come out to 1 to 3, because it would mean that I'm consistent. I'm actually achieving that target I have, and it's the ideal target in my head at least. And let me tell you why. Because well, I can probably show you. I'll probably show you, because the reality is that um 1 to 3 is ideal. 1 to 3 is ideal. 1 to 3 is 1 to 3 is ideal because holding for longer is risky. I'm gonna show you 1 of the trees I took where when I get there, I'll show you why I said 1 to 3 is ideal. I mean, mathematically works out. I can't go through that now, but mathematically works out where, as you can see, I lost less than I won less than 50%, less than half the trades I won them, and I still end up being positive. And that's because of the risk to reward ratio that I was going for. Risk to reward is how much you're risking versus how much you're gaining. So it's 1 to 3. Risking 1 to gain 3. Right? They add this really cool feature to the thing where it allows you to do like a daily tracker, right? So like a tracker on each day. So you can set up rules for a specific day. Let me see if there is. So like on this day, this is the 9th. I don't even know how to even read this. I think the days on this is, I think the dates are wrong, but I don't know if the date in this thing is set properly, because it's saying that the 8th was up, which is wrong. The week started on yeah, something's wrong with it. So I started trading on the 5th. Where can I find the 5th? All right. Oh, last week was when? Last week was the 6th. The Monday was the 6th. I can't find it. Yeah, so what is saying that I should start my trading there around 7. I might end up changing this rule. Start my trading there around 7 o'clock. I need to make sure I link all of my trades to the playbook. So this is a system that's making discipline. Make sure I link in all the trades to the playbook. And what linking the trades to the playbook has taught me is that if I cannot actually link a trade to my playbook, meaning that it doesn't match my playbook as I've defined it, then it's not my trade or something is wrong. I'll show you what the playbooks are after this. All right. So I make sure I put a stop loss on each trade. The maximum loss is defined for each trade. Let me show you the rules are. Let me show you my rules are. So I change the time to start at 9. I need to link all of them to a playbook. They should all have a stop loss. I think I have it as 2.5. I might end up putting it back to 2,000. I'm not sure why I pushed up to 2.5, which is about 1.25%, which is not really bad either. And the max loss is 10,000. So if I end up losing $10,000 in a day, I'm done for the day. I need to stop, cool off. All right, because clear something is wrong. But yeah. Now the playbooks, my playbooks are really, really simple. So is it a trend following, which is, as you can see, most of my trades were, so out of the 15 trades, 2 of them were not my trades. So I call this not my setup. So the default thing to classify those that were really my setup. So I messed up here. But then these are really low because I would have realized quickly that they're not my setup, and I've exited them. All right. There's 3 of them that are breaking structure. I got all of those. I lost on all of those. So the one that actually where I made all of the money is all of the wins, all the money, not the wins, because I would have lost some of these two, would have been the trend following. The trend following is very simple. The market is in and I speak about trends in the I speak about trends in the course I created or the few lessons I've done. So you can check out what the trend is. But the trend is your friend. You want to trade in the direction of the market. You don't want to trade against the market. You don't want to be the odd guy out going against. Think about it. Everybody is running. Let's say you are going through a crowd, everybody's running in one direction, and you decide to run against them. You're going to get trampled, right? Or your likelihood of getting trampled is higher as opposed to if you're running with the crowd, in direction of crowd, right? So this trend following, And you'd also have to define rules for these as well. Let me see if the rules are in here. And the rules are really simple. And then what you also do when you're linking the trade to the playbook, you have to indicate if the rules have been met. Now, not all of them need to be met for it to be a valid trade, right? If you look, only 70% of them met this. So usually my entry price has to be that price rejecting a key level, it'll reject a daily level, fib level, a week level, or a session high or low. I spoke about sessions again. I spoke about sessions in the course. So this is not necessarily a course to teach. It's not a video to teach, but there's some nuggets that you'll be able to pick up. In direction of the 4 hour. So I would have to be trading in direction of the 4 hour trend, and the exit is usually like the negative fib extension. I show the fib in the course. Guys, look at that, and it's usually the exit criteria. It should actually be entry criteria. It should actually be. I think these are mixed up. This should be here. It should actually be down here. The exit criteria. I'm not sure. But it should be the part of the entry criteria. Start of a session or a crossover. So that's based on the end of the start of a trading session or at the right or the crossover of 2 sessions. Yeah. I think these are classified wrong, but yeah. So let me just probably pick a couple of the trades and go through them as the start of the week. So let me go. So you can actually see the trades on each playbook. So let me go trades on each playbook. So the playbook where I made actual gains, that'll be the trend following playbook. And this is the executed trades. So I think it's 10 in total. 10 trades. I was going to show you something, right? When I say like timing, okay, there's a lot of things to consider when you trade and stuff. You can be right out direction, I ended at the wrong time. Right? So let me show you an example of that now. This trade, so I can look at this one. This trade is a trade that I lost, right? I ended up losing $2,000 on that trade. And the journal is so powerful, I lost the end like screenshot. So this is where I would have entered. I entered the trade like pretty early in the week. It might have been Monday morning or Sunday. I think it might have been Monday morning. But I entered the trade pretty early. Now there's a trend following trade where the market gold is actually in an uptrend. So I'm buying. Gold is going up, so I'm buying. Now I end the trade right here. All right. But then how it ended up playing out is the market went right, they're gonna stop me out. So it took me out. All right. No, it ended up stopping me out, right? But it was wrong. Because what happens is I end up re-entering the trade. So let me show you. And then there's also the condition that what happens is that I wasn't buying at the best price. So there's that. I wasn't buying at the best price. So I call these levels like liquidity levels, or there was another what do I call it now? There was a more liquid level for me to wait up. I didn't wait. This one is a valid level too because of what happened here, but it wasn't strong enough to hold. So the price ended up falling into this level, which is one I really should have traded. So I wasn't buying at the best price. The best price would have been down here. All right. So the market ended up doing that. No, I re-entered. Let me find a trade. So I end up re-entering gold. So that was the next trade I took. So I ended up re-entering. When I see the price drop into that level, which is the best price, 11 with a 78% fib level, I said, all right, that is a trade. And I entered it. All right, so I got the screenshot going to show you me entering down here. Matter of fact, when I saw it, it already moved. So it already dropped in the level, it already moved a great deal, and we enter right there. Now, this trade ended up running up. All right, so now I'm going to the point I mentioned around ideally you should go for 1 to 3. Now I'm going to show you why. So as you can see, after it ran up, so this is where I entered. This is a lower time frame, so it looks a little different. After it ran up, the market actually went all the way up here. All the way up here. But my target was all the way here. I think my target was like a 1 to 5 or something like that. All the way up here. But then look what it did. It retraced. And then I started to panic. And then the tool is so powerful, it can tell you how far it went. So let me just show you. So on this inside, it would have shown me that the market actually went to 1 to 4. Remember, I was risking $2,000. So it told me that at one point you were up $8,000. So at one point I was up 8,000 on trade. But because I was trying to hold for my initial target, which was way greater than 1 to 3, it actually got to 1 to 4. And I eventually closed it after the market started to retrace. So the market pulled back. I decided to enter a second position, which is what you see here. And it pulled down like this, and I panicked. So that's where, so because I didn't stick to the 1 to 3, because if I stuck to 1 to 3, I'd have gotten the $6,000. And I'd have gotten the $6,000. What ended up happening is that I closed the first position at 5,000. So this one ended up coming out at 5,000. This one ended up coming at 5,000. And the second one I entered, the code that we call like scaling, the position I was trying to scale in, that one I ended up closing that one in a loss, which is here. So the net effect of that ended up being like way less than 1 to 3. So I ended up coming out at probably 4,000 in total. End up being way less. It may end up being 1 to 2 thereabout instead of a 1 to 3. But if I initially gone to 1 to 3, I'd have gotten $6,000, so I end up getting less. So you can see where the market will push up and it will come back. I was afraid for it to come all the way back and stop me out. So I end up panic and come out. Right. I can actually stick to gold just to show you how the market operates. I guess let's stick to all the gold trades, right? So there was that. So I end up coming out of gold. I end up coming out at around, so then I lost this trade at the start of the week. This I ended up close at 5,000. Less than 1 to 3. But then we did enter this second position, which I ended up closing in loss, manually closing in loss. Right. So this, and the net effect of this ended up being like 4,000 something, ended up being 1 to 2. Now sticking with gold. And I end up entering gold again. Again, gold is in an uptrend. So all you see for gold areas are buys. I only buy for gold. This doesn't show the trade type. All I was doing for gold is buy, right? So this is a long. Now, this position, I think I end up. I'm sorting my notes, sorry. So I ended up entering this. I think that this might have been the middle of this. What time? This is like that far. This is like the end of the day, which I should not be doing, right? Should not be entering trades at the end of the day. So I entered it because again, this is actually my setup in a sense where this is actually my trade. Market pushed up, retraced back to between 78 and 68%. But then the timing was wrong. So I didn't follow all the rules of my setup. Timing was wrong. It wasn't at the start of the session. It wasn't a crossover. So it wasn't an ideal entry. Now, I eventually closed it in profits though. Oh, is it? This is it. Hold on. But yeah, obviously, I eventually closed it in profits. So I eventually closed it. I didn't have to show where I entered. I don't know if this is where I exited, but I eventually came out of it in profit. But what my notes here is saying is that the price did pull back massively during New York. So the price had actually like plummeted back during New York. And I would have re-entered during Asia. So let me show you that Asia trade, which I think was the biggest one I took for the week. Right. So after the market had pulled back during, so I manually exited, which is a good thing that I had manually exited. What is a screenshot? Oh, let me go to the actual trade. Sorry. So, so I end up coming out with a positive here, but it could have easily gone against me, right? So I should not be doing this. So this, even though it come out in a positive, it's a bad trade, and I don't consider it like a win. It's a bad trade, right? So now as I said in the previous, when I was looking at the previous one, it ended up pulling back, so it would have stopped me out. And then now I re-entered in Asia, which would have ended up being the biggest trade for the week, $10,000, which is actually the bulk of what I'd made. This is the bulk of that 12,000, right? So the market pulled back. Market pulled back during Asia. And guess what I did this time? What I did this time was to go for the 1 to 3. All right. I went for the 1 to 3. And look what happened. I went for 1 to 3, and the market ran right through 1 to 3. What if I didn't go for 1 to 3? Look what would have happened. So after the market hit my TP, the market ended up coming right back. I was at this point when this spiked out, I was already out of the trade, right? Because I got hit TP. But while I was sleeping, this is while I was sleeping. And the red here represents London, which is during, in my time, this is 3 o'clock in the morning, 5 o'clock in the morning. It would have come back and stopped me out. Now, this would have upset me, right? So this is why I was saying that 1 to 3 is ideal because of these things. You might be greedy in a way for more things, and you end up losing. So you can't be greedy, right? So the market end up coming right back. Stop me out. In fact, I just realized that when I exited the trade, the one I exited, I never necessarily, well, actually got a better entry. When I exited, I actually got a better entry. Or was it this one? I can't tell which one the position, but I know I manually exited it. But yeah, and that's kind of some of the stuff that I would have gotten. And some of the learnings. So 1 to 3 is a must, right? Timing the trades and make sure I'm actually entering at proper times. Start of the session, crossover. No in the middle, no end of the day when liquidity in the market is low. Liquidity doesn't mean Monday market. Nobody now spend the money right now in the market, so you now get things to move as much. Right? There's also like notebooks that allow you to like record notes. I can't recall what I had for the notes for last week. But I don't know. I don't think I have a notes for last week. Start of the week. But these are like my notes for this week, right? I just kind of put in my bias for the week. And that's kind of how I go about it, right? What I would do is I would go to the charts and just determine what my directional bias is for that week. Directional biases mean, based on what I'm seeing, what I think the market is going to do for this week. It'll go up, it'll go down. And then I try to stick with that bias throughout the week. So if, like last week, I believe that gold would be going up. And so all I did was buy. No selling. I mean, you can sell if you're skilled enough to sell, but I'm just not comfortable doing those sells. And I call it counter trend trading. Some people can counter trend trade, others not comfortable doing counter trend trading. All right, keeping it very simple. And that's not like the main things with Forex, keeping it very simple. All right. So yeah, maybe I should look at some of those that I lost. Let me just look at some of those that I lost. But that's fine. Even in the same playbook, because again, no strategy is 100%. So even though I'm saying this is my strategy, let me see what the win rate was for the strategy. The win rate was 50%. So I lost 50% of trades that I took with this setup, with this playbook. Let me look at one that I lost. Which wasn't even a lot of trades, you know. All right. UJ beat me up last week. So I don't think I barely made any, I think I barely made anything on these trades. So look at Ornamental lost, right? Somebody, I think I manually exited a lot of these trades. When we look at the entry rule, I didn't even mark the rules. But let me look at the attachment. This is what I used to kind of really. Oh, I wanted to show the exit. I wanted to show the stop loss. Hold on. And then we kind of recreate it around here. Yeah, so I still would have lost this trade regardless. But let me show you what I was looking at when I was entering it. It wasn't really clean. Right? It wasn't really clean. So again, I use the fib a lot. Right? That's my little thing. The fib. In fact, all the trades I take, the fib is on there. Half a bit on there, right? So the market, and I'll show you how the fib works. So the market swing high. So the market swung from here to here. It retraced. So my directional bias for the user was also up. It retraced, and then it rejected. In fact, if we actually wait on this, I think this is also one that I entered. No, I don't remember. This is the 4 hour. I might have entered this like early during Asia. But as you can see, and I might have been in profits for this trade at some point too. Right. So at some point I was in profits, but then it ended up turning back. But I would have entered after it rejected the 61. And I noticed that the safer entries are those that are deeper within this range. So between 61.8 and 78.6, deeper within that range is the better entries. As you can see, what the price did, the price actually went after it stopped me out, it actually went lower, rejected the 78, and it pushed right up to my actual. It pushed right up to my actual actually still I can stop it again. Normally I wouldn't. This is just a messy execution of this strategy. It is never clean. The price action was just like very just not clean. Yeah, it never clean. It never clean. But that's one of them that I would have lost. Let me see if there are any others. If you can see, I only lost on UJ. Oh, did I lose on GJ? Oh, I only lost on UJ for this trade. Let me check another playbook to see if there's anything that I would have done properly on. Yeah, all my GJ trades I lost them this week. Let me look at this one. GJ is one of my favorite pairs. My direction bias, this was also up. Oh, it's actually down. Yeah, this one gonna really upset me because I think something why this one upset me because I actually entered the trade and I manually exited. Is this the one I manually exited? There's one that I manually exited. This one, this did just play against me, so this never work out. And for these, I'm just one notes, right? I think for these, I didn't have proper reversal patterns. So the entry was forced. I did not wait on a break of structure on the lower time frames for the reversal, and price was trading in as, and price was not trading in any zones. But let's say it works out. So this is my initial thought when I enter. I got stopped out. It was a bad premature entry. And in the weekend review, I said it is not a proper execution of the strategy. I need to seek out the demand and supply zones. Right. So the market never really worked for me. At least not for this entry. So I think, however, though, there was another entry. So I would have re-entered at some point, right? Which I think was here. Now this one upset because the market is stopped me, but when it went higher, it actually did what it actually played up. So okay, so this is it. This is now the same. This is the same setup, so the same strategy, but this one now was cleaner because there were signals of reversals here. So swing low, so the market would have dropped, then it retraced back up, and it rejected the 78% level. This is a supply zone. So I get the zone on this trade, and I enter, and I wait for the market just play out. And I did not hold it. As you can see, it ended up in a loss. Pretty much break even. With them kind of money, pretty much break even. But still, man, let me show you it played out. I think at the end up was paying attention to something. I think I took it out of chart, I was paying attention to one little line, yes. So I was paying attention to this. So I was saying it come back, it is rejecting this, so it now gonna drop. I don't know why I did that. I don't know why I did that. But yeah, I just did. And look what happened. The market tanked. I think it even went further than this. It ended up going all the way down here eventually. So there's a trade I missed because that's where the emotions come in, right? When you start to overanalyze, it just start walking a foolishness. But the market just plummeted right down. And I missed that. End up missing that. And it was in profit at some point too. And it just eventually pulled back. But yeah. Those are like my key takeaways from last week. I need to have I need to wait on cleaner, higher probability setups and trade them. Yeah, so they're like decent learnings from last session. What I'm going to do to close out this one, or what I try to do each week is to kind of show my weekly outlook. So if you trade, maybe there's some nuggets you can get from it. I don't know, but it's not no promise or it's not financial advice. All right, just me showing you what my thoughts are. So what I'm doing each week, I am going to each week, where is it? I am going to, so week 2, which is the January 17 to 13, I'm going to put my bias for each, right? So my bias for gold is bullish. Bullish mean up. So let me show you the gold charts, what I'm seeing on the gold charts. So on the gold charts, why is it moving so slow? All right. So what I do, every week I always mark on last week's low. So this is the week that ended last Friday, the 6th. No, last Friday, the 10th. All right. So I put on last week's high. So this high is the week the market went. This is the lowest it went. All right. And usually what I do, I try to see my setup even on high time frame. So what I'm seeing now, my thinking is that price. All right, price does swing from down here all the way up here, and then it has started. It is retraced. As you can see, it start. If you realize there are multiple projections in this area, multiple projections, which is actually one of my reasons why my bias was bullish last week as well. Multiple projection from this area, which is also the 70 between the 60 and 78% field level. So at some point, what I call them that a weaker cycle. So once there's a swing, once there's a rejection at this level, I consider the cycle completed when the price actually reaches up to negative 27 extension. That's what me consider the cycle completed. So I think that on the weekly, gold is still in this cycle, and I still expect it to push all the way up here. Then, and what to also note, that don't mean that got this week. We can tell you that market is very weird. That don't mean now push down anytime at all. That's why you have to just watch it and just react to price as it gives. Price is giving you the information in real time. The market gives the information in real time, and you have to be adaptable and adjust the information as it comes. It don't mean as the market will just fly up. It might take weeks, might take even months for it actually reach a person. If it does reach, it must reach either. It can come back and second reject. It can literally drop from this point. That's just how the market works. Right? My directional bias is up. Now, on lower time frames, it's kind of the same thing where I have the fib on each level. So I have a cycle happening on each level. So this is where the market is in this weekly cycle. On a daily cycle, I put the fib here. So from this swing low all the way to this swing high, I'm thinking that the thinking is that price may retrace back down here before it continues going up. All right. But there's also this level here that there might be some reaction to. So it could come here, turn back, then push up, and then come back down here. Anything can happen. All right. You watch the market. If there's opportunity to sell, I might sell down here, or just wait until the market come down here. I don't must do that either. Again, the information comes, you use it. And then now on the what I call the 4-hour cycle. So there's a separate fib. Let me take out, well, the daily fib can stay on there, but I might take it out just, let me take out the daily fib from this. Could keep it. Just for it to be clean. Now, this is what I'm calling my 4-hour fib level. So the price could actually come down here and then push up from here. So this is a cycle, and this I call this the 4-hour fib cycle, 4-hour cycle, which has not started yet, right? But the price, based on the level here where the price I reacted to before, it couldn't break through. I could get a retest of it into this area for it to continue going up. So that's my immediate what I'm immediately waiting on gold. I retrace into the here for it to continue, or just watch it, because if it breaks this and give it some structure to the downside, I might end up selling it into the daily level, right? This daily level here. I might end up selling it into this level. Let me just put it down there just so I can show you. So I might say you have to just pay attention to the market, right? You just pay attention and just know what's happening. So what I'm saying is that if the market actually pushes down here and breaks this, I mean, then again, the daily Fibonacci is so close. The Fibonacci is actually really close. If you push down here, push up back, give me some down structure, I might end up selling it right down into this, if the opportunity presents itself. Isn't it? So, or it could just go straight down into this and give me an opportunity for buy go up. So I'm just pay attention to the market. But that's the one. I don't want to be there too long. That's the one I'm gonna go through today, because gold a very common trade pair. But let's stick around. Let's see if I can be consistent. I mean, I don't have no target in mind for the demo. It's not like I try to look for a specific target. I'm not focused on the gains. I'm not trying to focus on the execution of strategies, the consistency, right? Because I'm just saying, if the thinking is, if I make a conscious effort for 1 year to practice good habits, then it must become a part of me at some point. So that is the hope. To trade long enough where the thing becomes second nature and the bad habits have left. But yeah, but until next time, guys. Oh yeah, I didn't want to look at if there's any new. I haven't, to be honest, I haven't been using this much, but there could be financial news that can impact the market. I don't know if there are any high level news this week. I think maybe Feds. Oh shoot! So Tuesday, inflation news comes out, and inflation impacts the market, right? I think right now the Feds start cut rates. They did cut rates. They start cut rates. I don't know if their powers are really not been following the fundamentals. That's in news. So I know they cut rates. I'm not sure if they stop. But the reading from the CPI coming out, let me see if inflation has fallen. Let's show you the history. If inflation has been going down. Let me see. Kinda. I look so I want to forecast in there. Okay, it's a little ugly. Yeah, it kind of has been falling. So it has been falling from February of last. Yeah, from about May. Yeah, it has been on a downtrend. So it has been falling. Well, you can see 2021, this will be like probably like peak COVID them time the inflation was high. And as you know, as they come out of the pandemic and stuff, and the Feds were raising rates. So there's again, I don't want to teach in our lecture right now, but inflation is bad for the economy. And the Feds try to control it by raising rates. When they raise rates in the US, and the Feds, I mean US Federal Reserve, which will be the equivalent to our central bank here in Jamaica. When they increase rates, is hopes of slowing inflation. So increasing rates makes money more expensive, meaning, yeah, make money more expensive. So if you don't plan for that business, right, and the Fed start raise rates, it increase bank rates. So the rates, these Fed rates are called policy rates, impacts the financial market, right? Because maybe I explain why, but it impacts it. So if the Fed start raise rates, bank loan rates are go up. But the banks actually borrow money from the central banks to lend to you. And so because they want to maintain their margins, them raise rates. So money will come more expensive. Now you're gonna say, all right, I can't bother open my business. And so it kind of slows the economy. So there's a negative side thing, because eventually it will slow the economy. And it can slow the economy to a point where it goes into recession. So it's a balancing that the Fed has to do. They want slow inflation, but they also want to ensure that you don't stagnate the economy. You don't want to go into a recession. So they've started to cut rates because the inflation started to react to the inflation started to kind of react to the increase in rates, and so it has slowed down. And the inflation reading comes out every month. So this is point over point point to point, they call it. Point to point, so it's month over month. Prices increase at a rate of 2% month over month. Right? Inflation is always there. In the Canada had never had that. Inflation is always in the economy. But what you want to do is to slow it. You want it to be as slow as possible. All right. And then there's also this is core CPI. So I think core CPI has a specific list of things in there. And then there's the general PPI. Yeah, but essentially it's producer price index. Wait, if I wrong thing, I thought, oh, it's not CPI this. It's actually not CPI, but it also impacts oh shoot, the rise was CPI. No? Yo, okay. I don't edit this stuff, guys. So that's kind of everything just started. But yeah, this also feeds into inflation. So let me just wrap it up. This feeds into inflation, right? If it's costing more to produce goods and services, that costs more for you buy it. Right? The cost of the thing going to increase. So it also feeds into inflation. So it is something that we have to look out for as traders. Yeah. All right, guys, this is where we're at now. Until next time, SJ Fibonacci.